The most critical, non-negotiable signal emerging from the current economic landscape is what analysts are terming a hiring recession. This is not a headline-grabbing crash or a sudden spike in layoffs. It is a slow, insidious erosion of labor market health that acts like a heavy anchor on the entire economy, and by direct extension, the speculative arena of cryptocurrency. To understand why this particular data set is so damning, we must move beyond the superficial top-line number and dissect the contradictory signals within the latest jobs report. The surface-level data presented a paradox. The U.S. economy added a surprising 74,000 jobs in November, surpassing expectations. On its face, this suggests resilience. However, the devil and the true market risk is in the details. The unemployment rate simultaneously ticked up to 4.7%. This combination is a classic sign of economic softening. It indicates that while some hiring continues, the labor force is growing or churning in a way that outpaces job creation. The number of people actively seeking work but unable to find it is rising. This isn't growth, it's stagnation manifesting as a subtle but persistent leak in confidence. The ramifications of this trend are multifaceted and create a domino effect that directly undermines the foundation of a bullish risk asset thesis. First, it strangles consumer confidence and spending power. The average American household is not primarily driven by the performance of the S&P 500. Its economic reality is dictated by job security, wage growth, and the ability to manage monthly expenses. When the jobs market softens, wage gains inevitably slow, as seen in the current data. Consumers become cautious. Discretionary spending, the kind of extra capital that might flow into speculative investments like crypto, new tech gadgets, or luxury goods, is the first budget item to be slashed. A fearful consumer base retreats, contracting the very economic activity that corporate earnings and, subsequently, stock market valuations are built upon. Second, it places the Federal Reserve in a policy straitjacket, creating market uncertainty. The Fed's dual mandate is price stability and maximum employment. For over a year, the fierce battle has been against inflation, warranting a regime of a softening labor market is the primary data point that could justify a decisive pivot to aggressive rate cuts to stimulate the economy. However, the current data is murky, not weak enough to scream emergency, but not strong enough to signal all clear. This puts the Fed in a wait-and-see holding pattern, perpetuating the very uncertainty that markets despise. Investors are left guessing. Will the Fed cut to save jobs, potentially reigniting inflation? Or will they hold firm and risk tipping a softening market into an actual recession? This unresolved tension freezes major capital allocation decisions. Third, and most crucially for crypto, it reprices the risk premium. Assets like Bitcoin and altcoins are, in traditional finance terms, high-risk, high-potential reward bets. Investors allocate capital to them when they feel confident about the future, when they have excess capital and an appetite for growth over safety. A weakening labor market is a fundamental threat to that confidence. It shifts the collective psychology from growth-seeking to capital preservation. Money flows out of speculative assets and into perceived safe havens or cash. The risk-off sentiment becomes the default market mode. Crypto, sitting at the far end of the risk spectrum, is often the first asset class to be sold and the last to be bought back in such an environment. This isn't a short-term blip. The script notes that job growth has been nearly flat since spring, with over 700,000 more people unemployed now than a year ago. This is a trend, not an anomaly. It suggests the economic engine is losing momentum after the post-pandemic surge. For the crypto market, which often acts as a leading sentiment indicator, this trend is a powerful gravitational force. It means that any short-term rally or positive catalyst, be it a technical breakout or promising regulatory news, is fighting against a profound macroeconomic headwind. The hiring recession argues that the economic soil is becoming less fertile for speculative growth. Until there is a clear, sustained reversal in labor market health, characterized by falling unemployment alongside robust job gains and rising wages, the overarching macro environment will remain a significant unshakable drag on any sustained crypto market recovery. The anchor remains lodged deep, and the tide of economic data is not yet strong enough to lift it. The current state of the cryptocurrency market is a masterclass in negative sentiment feedback loops. It's not merely experiencing a downturn. It's trapped in a self-perpetuating psychological cascade where one source of fear feeds directly into the next, creating a paralyzing cycle that has extinguished the typical year-end rally. To understand the market's paralysis, we must map this cascade step by step, seeing how a crisis in one niche corner of the ecosystem can ripple out to freeze the entire arena. Stage 1. The cascade begins not with Bitcoin's price, but in the specialized and highly leveraged world of digital asset treasury firms and crypto-native financial institutions. These entities, which manage assets, provide lending, and create complex yield products, have been hit by a perfect storm of falling asset prices, collapsing leverage, and a crisis of confidence. As they trade at or near historic lows, it signifies a profound institutional distress within the crypto ecosystem itself. This isn't retail panic selling. It's the equivalent of investment banks failing in 2008. It creates a foundational tremor of insolvency risk that shakes every participant who is intertwined with these entities. Stage 2. The sector-wide contagion, crushing core sentiment. The distress of these foundational firms creates immediate, tangible fear across the entire crypto sector. Questions arise. Which project or protocol is exposed to these failing firms? Will there be a chain of defaults? Is my asset on a vulnerable exchange or in a compromised lending protocol? This fear leads to a broad-based, indiscriminate de-risking. Capital isn't just moving from altcoins to Bitcoin, a flight to quality within crypto. It's fleeing the crypto sector entirely. Liquidity drains, trading volume dries up, and the entire market enters a state of defensive hibernation. The innovative potential of DeFi or new loans becomes irrelevant in the face of existential solvency fears. Stage 3. The retail exodus enthusiasm meets reality. The most damaging consequence of this sector-wide fear is the complete evaporation of retail enthusiasm. The average crypto investor is driven by narrative, community, and the thrill of participation. When the headlines shift from next 100x coin to another crypto firm faces liquidity crisis, that enthusiasm turns to apprehension, then to exit. Retail investors are the lifeblood of market volume and the primary drivers of meme coins and speculative altcoins. Their retreat isn't a calculated move. It's an emotional one. They log out of their wallets, stop checking charts, and disengage. This loss of the participant base creates a silent, hollow market where even positive news finds no buying pressure. In Stage 4, the peripheral collapse, AI and meme tokens starve. With the core crypto sector in distress and retail fleeing, the contagion spreads to the market's most speculative peripheries. AI-themed tokens and pure meme coins. These assets are not trading on utility or fundamentals. They are purely vehicles for narrative-driven risk on sentiment. They are the proverbial canary in the coal mine for speculative appetite. When fear grips the core, these assets are annihilated because they have zero defensive value. Their collapse isn't just a symptom. It's a powerful visual signal that reinforces the panic. It broadcasts a clear message. There is no safe harbor for speculation here. This visual proof of total risk-off behavior further validates the fears of those in stages 2 and 3, intensifying the loop. Stage 5, the death of the narrative no rally to believe in. The final stage is the death of any positive forward-looking narrative. The hoped-for Santa rally or year-end surge is a narrative built on historical pattern and collective optimism. The cascade of fear shreds this narrative. Markets move on stories, and the dominant story is no longer about cycles or seasonality. It's about contagion, insolvency, and retreat. When the narrative shifts from when will we go up to who is going under next, attempting to buy a rally is seen not as opportunistic, but as foolish. This narrative vacuum is paralyzed. It leaves the market drifting without a bullish catalyst strong enough to counter the emotional weight of the fear cascade. Breaking the cycle, this cascade creates a market that is fundamentally reactive, not proactive. It isn't analyzing data, it's flinching at shadows. Every minor sell-off is interpreted as the start of the next leg down. Any potential positive news, like a regulatory development, is dismissed as too little, too late, or is irrelevant to the solvency. The market becomes its own worst enemy, where the collective psychology of fear becomes the most significant price determinant. Breaking this cycle requires an external shock powerful enough to disrupt the feedback loop, a massive, unambiguous influx of capital, institutional or otherwise, a definitive resolution to the core firm crises, or a macro shift so positive it overrides the internal fear. Until then, the market remains trapped in its own psychology, where fear begets fear, liquidity evaporates, and rallies are smothered before they can even begin. This is the anatomy of a paralyzed market. The current extreme concentration of market value and earnings within a narrow band of traditional stocks is not merely a curiosity. It is a structural vulnerability that radiates instability into every corner of the risk asset universe, including cryptocurrency. When the top 7 companies account for over a quarter of the entire S&P 500's total earnings, we have moved beyond a simple trend into uncharted territory. This concentration creates a fragile monolith, a market that appears robust on the surface but is dangerously dependent on the continued, flawless performance of a tiny elite. The profound implications of this setup create a pervasive climate of caution that directly chokes off the speculative oxygen crypto needs to thrive. The mechanics of the monolith. A distorted reality. This concentration signifies a massive distortion in capital allocation. Investor capital is not flowing into a broad-based economic recovery or betting on diverse growth stories. Instead, it is performing a frantic flight to perceived safety within the risk spectrum, piling into the handful of mega-cap technology and AI companies seen as unassailable winners. This creates a self-fulfilling prophecy. The influx of capital drives their prices and valuations higher, which in turn makes their weighting in indices even larger, forcing passive funds to buy even more. The result is a market where the market no longer reflects the health of 500 companies, but the sentiment around. This distortion breaks traditional diversification models and forces all market participants, from hedge funds to retail traders, to become de facto analysts of this one narrow segment. It is a hyper-focused, high-stakes game where the fortunes of the many are tied to the fate of the very few. The mirror in the altcoin market, a pattern of dangerous behavior. Until this concentration breaks through either a dramatic broadening of market participation or a painful correction in the megacaps, it will continue to cast a long, limiting shadow over all speculative appetite, freezing capital at the very top and leaving the rest of the market, including crypto, in a state of precarious drought. January 25 is shaping up not as a mere calendar turn, but as a critical stress test zone where two powerful, data-backed, yet diametrically opposed market narratives will collide head-on. This isn't a vague debate about sentiment. It is a quantifiable confrontation between a bullish case rooted in post-crisis recovery timelines and a bearish warning etched in the cold calculus of liquidity indicators. The outcome of this clash will set the tone for the entire crypto year, determining whether we witness a spectacular momentum-driven breakout or confirm the beginning of a prolonged structural decline. It's the market's ultimate fork in the road. Narrative A. The historical reversion thesis. The 8th week bounce. This bullish narrative is built on a compelling and specific historical pattern. It argues that the crypto market operates on a predictable, almost mechanical, schedule for flushing out systemic leverage following a major crisis. The thesis points to the precedent of the FTX collapse in November 2022. Following that event, the market entered a period of paralysis and fear, bottoming approximately 8 weeks later before commencing a sustained multi-year recovery rally that culminated in new all-time highs. The current crisis, the October digital asset treasury firm implosions, described in the script as more severe than FTX, is viewed through this exact same lens. Proponents, like the analyst Tom Lee cited, mark the calendar. Early December 2024 marks the 8th week since the October event. According to the historical playbook, this is the precise moment where toxic leverage has been fully purged, weak hands have capitulated, and the market, now on a cleaner foundation, is primed for a powerful recovery. The prediction of Bitcoin potentially doubling by January's end is not arbitrary. It's an extrapolation of this reset and rally model. The ultimate litmus test for this narrative is a specific price level, a break above $125,000. Achieving this, the bulls argue, would not just be a rally, it would be an event so powerful it would shatter the psychological and technical constraints of the traditional four-year halving cycle, inaugurating a new paradigm of market behavior. Narrative B, the macro liquidity warning, the 2021 echo. Arrayed against this optimistic historical analogy is a bearish narrative grounded in macro-technical analysis. This view sidesteps crypto-specific crisis timelines and focuses on a higher-order indicator, the global flow of liquidity into and out of the asset class, best exemplified by Bitcoin's monthly moving average convergence divergence (MECD). This indicator is not about short-term price swings. It measures the underlying momentum and flow of capital on a macro scale. The bear case highlights a deeply concerning parallel. The last time the monthly MACD exhibited the precise configuration of rolling over from its highs and showing a sustained outflow of liquidity was in late 2021, immediately prior to the catastrophic bear market of 2022 that saw Bitcoin fall over 75% from its peak. The script emphasizes that we are now witnessing the same signal. From this perspective, the October crisis was not an isolated shock from which the market will neatly recover in 8 weeks, but rather the first major symptom of a much larger, more insidious macro liquidity withdrawal that is just beginning. This narrative suggests that the post-FTX recovery was just a rally within a larger, unresolved downtrend. And we are now entering the next major downlet. The charts in this view are not setting up for a January moonshot, but are warning of a potential replay of 2022's brutal decline. The irreconcilable conflict and its stakes. These two narratives cannot peacefully coexist. One is a story of cyclic, crisis-driven renewal. The other is a story of secular, macro-driven decay. They are reading the same price action through entirely different lenses. The bullish lens sees the current sideways to down price action as the final compression before an explosive move up as weak sellers are exhausted. The bearish lens sees the same price action as a distribution phase, where rallies are sold into by smart money exiting the asset class. The stakes of this January pivot could not be higher. If the bullish 8th-week bounce narrative prevails and Bitcoin decisively breaks through its key resistance, it would trigger a tsunami of FOMO, fear of missing out, validate the most aggressive growth models, and likely suck capital back into altcoins at a ferocious pace. It would be a market-wide psychological reset. Conversely, if January passes with Bitcoin unable to muster significant upward momentum, or worse, breaks down from its current range, it would be a devastating confirmation of the bearish macro liquidity thesis. It would prove that the historical analogy has failed and that the powerful headwinds of global capital rotation are overwhelming crypto's internal dynamics. This would likely trigger a new wave of capitulation as the last batch of hopeful bulls finally gives up, potentially leading to a steep and demoralizing decline, the paralysis of the present. This unresolved clash is what creates the palpable tension and indecision in the current market. Traders and investors are frozen, unsure which script to follow. This is why volume dries up and rallies lack conviction. Half the market is waiting to buy the breakout, while the other half is waiting to sell the breakdown. January acts as the forced arbitration. The market will be compelled to choose a direction, and in doing so, it will validate one of these deeply held worldviews and violently invalidate the other. The resulting move will not be subtle. It will be a decisive lurch that defines the strategic posture for all of 2025, making the coming weeks the most consequential observation period for crypto investors in recent memory. It is the moment where history either rhymes with hopeful precision or diverges into a much darker, uncharted verse. In any typical market downturn, investors scan the horizon for potential catalysts. external events capable of injecting momentum, changing sentiment, and sparking a reversal. For crypto, the two most frequently cited catalysts are clear: definitive regulatory clarity and large-scale fiscal stimulus. However, the current landscape reveals a grim reality. Both of these potential engines for growth are not merely delayed, they are mired in political and practical quicksand, rendering them ineffective as near-term saviors, and instead contributing to the market's stagnant, uncertain state. Their paralysis forms a critical part of the bear thesis, removing the "something could save us" hope that often underpins bear market rallies. Catalyst 1. Regulatory clarity, a Herculean task in a dysfunctional arena. The promise of comprehensive market structure legislation, often dubbed the Crypto Clarity Act, has been dangled before investors for years. Its passage is seen as the key to unlocking institutional capital by providing clear rules of the road. Yet, the path to enactment is not a straightforward legislative sprint. It is an obstacle course designed by a deeply divided political system. First, the legislative process itself is a multi-stage gauntlet. The script notes the House may pass a version, but the Senate then enters a markup phase where the bill can be fundamentally rewritten. This version must then go back to the House for approval, creating a high-risk game of political ping-pong. Each chamber is influenced by competing interests: progressive skeptics concerned about consumer protection and financial stability, libertarian-leaning advocates pushing for minimal intervention, and traditional finance lobbyists seeking to shape rules to their advantage. The result is not a clean bill, but a heavily negotiated, potentially diluted compromise that may satisfy no one in the crypto community. Second, this complex process is competing for oxygen in a Capitol Hill perpetually on the brink of crisis. The script accurately highlights the looming threat of a government shutdown and the immovable priority of the annual defense spending bill. Crypto legislation, despite its importance to the industry, is not a national security or must-pass budgetary imperative. In the triage of congressional priorities, it is perpetually at risk of being pushed to the back of the queue or used as a bargaining chip in unrelated negotiations. The Herculean effort required, as described, is not just about votes. It's about finding a fleeting moment of congressional focus and functionality amidst chronic gridlock. This means the promised catalyst of January clarity is a fantasy. The process is far more likely to drag deep into 2025 or beyond, perpetuating the very uncertainty it promises to resolve. Catalyst 2. Fiscal stimulus, a question of destination, not injection. The second hypothesized catalyst is a macroeconomic one: the potential for the U.S. government to inject a $150 billion directly into consumer pockets via targeted tax refunds in Q1 2025. On paper, this is a powerful stimulus. However, for this to act as a crypto catalyst, a critical assumption must hold true: that a meaningful portion of this money would flow into digital assets. This assumption is highly questionable and exposes a fundamental disconnect between the crypto ecosystem and mainstream economic reality. For the median American household, a $1,000, $2,000 windfall does not represent risk capital. In an environment of high inflation, softening job markets, and elevated credit card debt, this money is far more likely to be immediately allocated to pressing needs: paying down burdensome debt, covering elevated rent or mortgage payments, rebuilding depleted savings, or purchasing essential goods whose prices have risen. This is capital directed toward financial stability and necessity, not speculation. Even for those with financial breathing room, the behavioral shift required is significant. The leap from receiving a government tax refund to navigating a cryptocurrency exchange, understanding self-custody, and purchasing a volatile digital asset is enormous. The more probable destinations for any discretionary portion of this stimulus are traditional, understood avenues: an extra mortgage payment, a contribution to a 401k, investment in a broad market ETF, or simply spending on goods and services. The idea that millions of Americans would collectively decide to route their refunds into Bitcoin is a narrative born within the crypto bubble, not reflective of broader societal behavior. Therefore, while the stimulus may provide a modest boost to the overall economy or specific consumer stocks, its direct impact on crypto liquidity is likely to be a small fraction of the headline number, a trickle, not a wave. The catalyst vacuum and its psychological toll. The paralysis of these two primary catalysts creates a dangerous vacuum. It strips the market of credible near-term "what could go right" stories. Investors are left with a harsh equation. The existing macro and internal headwinds are palpable and present, while the potential tailwinds are either stuck in political limbo or sociologically improbable. This erodes the patient accumulation thesis, as patience requires a visible light at the end of the tunnel. This transforms these stalled catalysts from neutral factors into active psychological weights. Regulatory delay ceases to be pending good news and becomes evidence of institutional indifference or hostility. The stimulus discussion ceases to be a potential liquidity injection and becomes a reminder that crypto remains a peripheral, niche asset class in the broader public consciousness. Their ineffectiveness reinforces the overarching narrative of isolation and vulnerability. In a market desperate for a hero, the would-be saviors are shown to be absent or irrelevant, forcing a sober reckoning with the market's own internal dynamics and the unyielding pressure of macroeconomic forces. The conclusion is stark. If a rally is to come, it cannot wait for these external rescues. It must generate from within, against a tide that is still flowing